Welcome, ladies and gentlemen, from me, Guy Monson, to our regular 6-minute strategy update. This week, I'm going to look at the impact of the uptick in infection rates, the tightening of lockdowns we've seen in the region, and the indicators that the recovery is slowing a little bit, at what this means for financial markets, and in particular for income and dividends. Let's begin looking at our regular 4 indicators to get some idea of the state of the world. US forward inflation expectations still trending upward, which is encouraging. The dollar, an extraordinary month, one of the worst in a decade. There's the trade-weighted dollar falling to 92.8. That's probably a good signal, both for US competitiveness and, of course, for credit flows into the rest of the world and the emerging markets. Another tip down in the Italian-German bond spread, a real vote of confidence in that European Recovery Fund. And good to see the IFO business survey, that's the big German manufacturing survey, showing a real uptick in expectations 6 months out. So people beginning to get a little more optimistic on trade. But this comes against a difficult backdrop. Lockdowns are being tightened in response to regional upticks in infection rates. This is our regular COVID stringency index, 0, no restrictions, 100 full lockdown. And you can see that a large part of the world is sort of flatlining in the 50s and 60s, which is tighter, I think, than we and many other economists had predicted at this point in the cycle. And there's some alarming upticks. Japan beginning to go from a very substantial easing, that pink line trending up. But look at the black line, Spain, rising from the 30s right up to the high 50s. That might have been something to do with Boris Johnson's decision to extend quarantine to passengers from the Spanish region. This week, we also got Q2 data. Of course, it's somewhat backward looking, but it's pretty horrific. Look at the US number, minus 32.9% if you annualize that second quarter rate. Look at that against the quarterly rates right back to the Second World War, just extraordinary. We had similar numbers out in Europe. They report slightly differently. They take Q2 versus a year ago. If I do that for the US, it's not 32.9, it's down 9.5%. Still an extraordinary number. The Eurozone reported minus 12.1%, so worse, and Spain an extraordinary minus 18%, which shows some of the pressure on their southern economies. Germany a little better, minus 10. Italy still awful, but ahead of expectations at minus 12.4%. I think what's worrying, though, is that if you look to more real-time data, continuing unemployment claims, that's a weekly number, are beginning to tick up in the States. And this echoes some comments from Chairman Powell of the Federal Reserve last week, who was nervous about some of the data he's seeing today. He identified in the press conference after his FOMC meeting that in recent weeks virus cases and the renewed measures to control it are starting to weigh on economic activity. He cited some high-frequency data, debit and credit card use, which shows another dip down. And importantly, he concluded that the current trends are fundamentally deflationary. And that's a big issue for our clients who are worrying about the long-term inflationary consequences of all this spending and government and central bank support. He indeed sees core inflation dropping to 1%. And the bond markets for the moment are back in, with US 10-year yields reaching a new low of 55 basis points. So what does all this mean for investors? Well, first of all, a real squeeze on income. Bond yields continuing to fall. For a sterling investor, A-rated corporate credit now yielding just 145. A 5-year gilt, minus 14 basis points. So real income squeeze for bonds. And in equities, still very high risks of further dividend cuts, as the dividend futures here show, which predict the likely trajectory of dividends over the next few years. Look how damaged, say, FTSE 100 earnings remain. So what are your solutions? One, buy thematic dividends, companies that can prosper in a post-COVID world and generate sustainable dividends. 2, look at infrastructure, where these big European and US green programs are generating infrastructure projects which will offer investment, flows and income, which will probably be inflation adjusted for many years to come. Secondly, look at a continuing large position in gold. We talked about this last week. We looked at the nominal price. This time I've looked at the real price of gold. That's gold adjusted for inflation. Now, 166 were not back through the highs after the Iranian Revolution, were not back through the highs after the Eurozone crisis. So my hunch is against this backdrop, gold can go higher. But note those peaks are quite short-lived. This is a strategic position that we have in portfolios, but not one we will hold forever. So to summarise the returns for a sterling investor for this year to date, gold's still the leader, up 30%. UK gilts up 9%, but broadly flatlining. World equities come off a little bit, flat for the year to date. Look though, the yellow line, UK equities still down 20% for the year to date. On the right, equity volatility down again, but still running at more than twice the levels of the pre-COVID period. So to conclude, the spike in COVID infections and the increase in lockdowns in certain regions of the world are going to mean lower rates for longer. A squeeze on income, I'm afraid, and a squeeze on dividends. What are the solutions? First, thematic global portfolios with companies that can prosper in a post-COVID world will pay their dividends. Second, look at infrastructure, particularly coming out of the Green New Deal. Thirdly, gold is a continuing important position in portfolios while there's this policy uncertainty, but don't stay there forever. Thank you.